Daniel Dubrovsky on global equities and market bubbles. It's all you.
Thank you, Todd. I will take it from here. So, about a year and a half from last year's bottom after the COVID outbreaks, US stock markets, they're still continuing to set new highs, but the pace has been uneven across various sectors of the economy. So given the resilience in equities, especially as they face current threats of slowing global growth and what could potentially in the not too distant future become Fed monetary tightening, is there room here for a healthy correction in markets, or could this evolve into something a little bit more worse, like a bubble? My name is Daniel Dubrovsky, DailyFX Strategist, and this is Global Equities and FICC, or Fixed Income Clearing Corporation, which is another fancy way of talking about treasuries. So is this a new normal, or could this be something else? So as usual, I'll just start these off with the risk disclaimers. So key points here are that trading foreign exchange on margin carries a high level of risk, and that may not be suitable for all investors. And so the possibility here exists that you could sustain a loss in excess of your initial investment. Now, the way I like to think about leverage is it being a double-edged sword. It can both amplify your gains, but it could also do the same to your losses. And any opinions, news, research, analysis, or other information contained in this presentation should be treated as general market commentary and does not constitute as investment advice. All right, and with that behind us, let's do a quick overview of the action plan. So we're going to start with talking about defining a market bubble before moving into a little bit of a brief history of some of the most prevalent market bubbles that we've seen in modern times. And then we'll finally move into the topic of trying to figure out if we are currently in a bubble. And actually, this painting that you are seeing on the slide is actually a pretty famous one called Wall Street Bubbles, Always the Same. And the person that is depicted in it is a bull by John Pierpont Morgan as he's blowing bubbles. This was actually made in 1901. So this was even before the Roaring 20s. And I think it is still very much prevalent today. And actually, a fun fact about this painting, we used to have this painting in our office here in San Francisco. All right, moving on here. So let's talk about actually defining what is a market bubble. So, it's somewhat of a loose meaning. They can vary here from time to time. And I suspect that as we go on throughout history, the definition can actually change and whatnot, perhaps as we become better, economists become better at predicting them and defining them. But generally speaking, what you're looking for in a bubble, it is a period of rapid expansion and price increases. That is then followed by a market slowdown and potentially a contraction. And these movements can actually be quite quick, typically characterized by an increasingly slope of rising prices that essentially it bursts, kind of like a bubble, and then everything falls to the ground. And some common themes in terms of what to look for in bubbles include things like displacement. So displacement is basically like, let's say there is a new product, let's say cryptocurrency, or a new paradigm, or just a new way of thinking, something that starts to get the attraction of people's attention for whatever reason. And that starts to go about, and then you move into what's called the boom. So for an asset in this case, so the prices would start rising in a boom and momentum would pick up, basically as new players begin to enter the market from all corners of the market. And something that I really want to highlight here is just a key impact of what has been because of COVID is really that new players entering the market, because a lot of people have been staying at home since COVID, and that basically translating to a lot of more people trading from home. We'll talk a little bit more about that later. But what a boom eventually can transpire into is a euphoria. And that's what I was talking about in terms of that exponential rise in prices. You get skyrocketing prices that accelerate, and caution starts to be thrown out of the window. And that eventually evolves into something like profit taking, essentially where people start picking at the top and closing and unwinding positions. Now, this is the most difficult part in terms of trying to, I think, define a bubble, because this involves, of course, playing with timing, and timing is notoriously difficult. That is something that actually we have a guide on DailyFX about how difficult it is to pick tops and bottoms in markets. But the profit taking could be initiated by some investors starting to book profits, and that causes a chain reaction similar to how a bubble essentially starts, and that eventually transpires into panic and liquidation. And there are a couple of types of bubbles. The first one is called the financial crisis, and when I think of financial crisis, you could think of like the Great Depression in the 1930s, and you can also think of the 2008 Great Recession. But in this kind of bubble, it results into a liquidity or a credit crunch, and that essentially the bubble and the bursting of assets themselves results in economic devastation. And the other type of crash includes flash crash, which is often temporary or short-lived. The S&P 500 Black Monday in October 19th, 1987, that was a flash crash as stocks fell over 20% in a single day. And sometimes these things could be computer and program driven. And by the way, they're not just exclusive to stocks. They happen in currencies too. The Swiss National Bank in 2015, the Swiss franc absolutely just soared after the S&P unexpectedly, without any sort of forward guidance, just decided to drop its euro cap against its own currency. And a recent example actually of a flash crash was the gold crash that we saw actually at the beginning of this week. So those do happen, and those are typically the kinds of bubbles that don't necessarily translate into a financial crisis, but they are there and they do happen nonetheless. So what are some causes of bubbles? Common causes include what you see up there at the top of the slide. And that includes things like cognitive dissonance. That's basically when you hold two opposing beliefs at the same time and you sort of ignore the other one. For example, like you think that the markets are overvalued, but at the same time, it's prime investing environment. Quantitative easing is actually another potential example of cognitive dissonance. Is it good or is it bad and whatnot? Anyways, new information is coming out, but that oftentimes is being rejected. And hurting is another great cause of bubbles. Another way of thinking about hurting is like FOMO, or fear of missing out. You hear all your friends talk about these crazy investment opportunities, and you don't want to miss out on them, so you jump into them. And that was also part of the housing bubble that we saw earlier in this century. Monetary policy is also something that is very highly debatable in terms of whether or not monetary policy can cause a bubble, because of policy prescriptions that central banks do to stimulate an economy oftentimes create conditions that are ripe for creating bubbles. And I'll talk a little bit more about this actually later in this presentation. Another cause of bubbles is moral hazard. That the theory being here is that no matter what, we will be safe. 2008, the housing bubble was a great example of that, because one way of thinking about that is like, worst case scenario, if people start defaulting on their mortgages, the banks will still have the value of the land and the value of the properties, which should remain high. So caution is being just thrown out of the wind. And another example of what causes bubbles is the greater fool theory. And that one is that it is always possible to make money buying an asset, because someone, aka the greater fool, will be out there willing to pay a higher price. This doesn't involve just the stock markets, but it also involves things outside of that potentially as well. And the chart that you see that below, the major market bubbles 10 years to the peak, gives you an example of sort of what I was talking about earlier in terms of the momentum behind bubbles, right? And it initially starts off pretty slowly, then it exponentially here rises. And then it happens almost very, very quickly. And why it is oftentimes so very difficult to pick those tops and bottoms. That is actually going to wrap us up with that part of the presentation in terms of talking about defining a market bubble and what causes them. And so at this point, we're going to transition into talking a little bit more about some of the major historical examples of bubbles. And so we're going to start off actually looking at one of the most famous and early examples in modern history of a market bubble, and that is called the Dutch Tulip Mania. And what you're seeing on the left is not just any regular tulip. I'm sure you've probably seen many kinds of tulips for sale in local grocery stores or flower shops, but this is what's called a broken bulb. And the reason why it's called a broken bulb is because it has stripes on it. And this flower was very highly sought after, this type, because of its rarity. But anyways, long story short, what the Dutch tulip mania is, Europe started to receive these shipments of tulips, and the epicenter of this was in Holland. And it basically got to the point where this piece of flower, this bulb, basically sold for more than 10 times the annual income of a skilled craftsman. Because when the first recorded market bubbles, and what's interesting about them is that we still have bubbles that persist from time to time. So even though that they happen, they still do tend to repeat over the course of history, which I think just really speaks more to human psychology and just certain tendencies and whatnot. But in addition to how expensive these got, these also reached prices that were the equivalent to a mansion on the Amsterdam Grand Canal. And so you could probably start thinking about, okay, well, why is this flower, why is this thing worth the same as a really, 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 really high income person or a really, really expensive piece of land and whatnot? And that is sort of where the tops of bubbles, they can start to come in, because reality starts to kick in. Because eventually, the market runs out of someone who is willing to pay a higher price for this, and that's where you get the profit taking. And basically, the market for these bulbs collapsed almost overnight. There was so little time to get out of the market when a lot of people were invested into it. People started buying these for not because of the fundamentals, but because they just believed that the price would continue rising and rising and rising, and they wanted to build wealth and whatnot. And historically speaking, the collapse of tulip bulbs actually rivals to what we saw happen actually in Bitcoin, not currently, but back in 2017 when cryptocurrencies blew off before being reinvigorated recently. But another key component of the tulip mania was that this event basically destroyed relationships that were built on trust. And ultimately, in financial markets in general, you can't really have a financial market if there is no trust, if people cannot be confident in the transactions. And that is actually another key lesson from the tulip mania. And so, yeah, so if you didn't know, there was a point in history when a piece of flour was worth more than a house. And that obviously did not last long at all. Another famous example of a historical bubble was part of what happened in the Great Depression in the 1930s. Now, the Great Depression itself wasn't just a collapse in the stock market. It was many, many things. And the stock market crash was just part of the equation, arguably something that made it worse. It was the first major developed world bull market that led to an excess speculation and extreme valuations in what was called the Roaring 20s. The Roaring 20s were a period of great just wealth, where the United States was exporting a ton to Europe, helping essentially the continent to rebuild from the First World War. Unemployment was low. People were getting more into, for example, automobiles, trying to spread across the country. Lots of jobs actually being created too. And then came basically the peak in the stock market. And it should be noted that during the Great Depression, you had a lot of new players too enter the stock market. It wasn't just the affluent, it wasn't just the wealthy that were trading stocks. It was general, retail trader too. I think the Great Depression and what led to it was a great example of that. And what you can see here on this chart, right, is again, look at the exponential rise in the Dow Jones. And that is something that actually we're going to see as a common theme across these bubbles, is that the initial startup in stocks is pretty tame. And then into the collapse, the price picks up aggressively, very exponentially, and then it drops off like a cliff. It started for the stock market crash in the Great Depression as Black Thursday. The market basically opened 11% lower, and at the end of the years that followed, the Dow lost basically almost 90% of its value if you were to compare it to its peak. And look how quickly, by the way, the value is eviscerated, right? It takes years to build up this growth, and it takes only just relatively short amount of time to just destroy it all. And that is another common theme that we should be watching for going forward in this presentation. But yeah, so the fall in the price of stocks helped to contribute to a broader financial crisis because confidence in the economy was essentially lost, and there were these things called bank runs, where basically small banks couldn't keep up with withdrawals. Everybody was trying to take their money out of the financial system because they were not confident and they wanted cash on hand. Cash is the most liquid asset, and during times of crisis, just like we saw during the initial outbreak of COVID, people don't care anymore about trying to make money in markets. They want to have money, period, because they need to pay off certain things. They need to survive. They need to pay for bills. They need to pay for food. They need to pay for water. And the bank runs was really what I think made the crisis worse because they were not insured, a lot of them. There wasn't no government insurance back at the time for that. And a lot of banks just went bankrupt because they ended up laying out most of the money prior to the crash, and they did not have the reserves to give out the money back to the people. So you get this just deep collapse in confidence, destruction of liquidity. And that was a big lesson for many economists that followed in the years to come in many textbooks and whatnot, and it's still referenced to today. So very, very important bubble there. Another more recent example of a bubble was the Nasdaq or .com bubble. This is where I think more of a new way of thinking was introduced, right? Internet companies and internet in general and .coms, the rise of tech. This is what you see here on the left and right side of the screen is companies that don't exist anymore. The one on the left used to be pets.com, and the one on the right is called WebFan. But yeah, so Nasdaq and .com bubble was a new way of thinking, new paradigm, this technology, the internet, the rise of the internet, and everybody trying to get on board with this incredible new thing that has since transformed human civilization for decades to come, years, centuries to come. And there's a lot of hype, of course, around it, and everybody's trying to sort of pick, who was going to be the winners and whatnot. And look at this momentum, right? Very similar to past bubbles, right? You get the initial slow buildup and then very rapid exponential rise in the Nasdaq rose basically almost 1,500% in value over the course of 10 years. And it had wiped out 80% of its value over the course of just a couple of years, which is insane. And the key takeaway, I think, from the Nasdaq bubble was that the bust of a lot of .com stocks, a lot of these small companies, and maybe a lot of people have not heard about yet, dominoed into blue chip tech companies, Intel, Cisco, Oracle. Those companies lost 80% of their stock value as well. So that also explains that, you can have a segment of the economy that does so poorly that can then start to domino into other parts of it that's more well established. So it's entirely possible that if we get a collapse in tech stocks today, Apple, Microsoft, Google, they probably won't be left unscathed. They will probably see those, returns be those losses be amplified because of other corners of the market if the bubble is in tech. So not every company is safe, no matter what the prevailing trend and sentiment could be. The next example of a market is the US housing market crash. It's actually going to be the last example that we're going to take a look at before talking to more what's going on recently here in financial markets, which is actually really, really interesting. So the US housing market crash was another very interesting part of history. So here it was culminated in real estate prices that started really in the late 90s. And after that dot-com bust here in the early 2000s, right, what followed was this eventually decrease in interest rates from the Federal Reserve that made taking out a loan, for example, or mortgage really cheap, a lot more cheaper than it used to be, and basically helped to fuel that. Not that Fed monetary policy alone was the cause of that, of course not. It is one of the many components of it, sure, but there were other more deep roots. For example, the U.S. government sponsored mortgage lenders, the famous ones, Fannie Mae and Freddie Mac. I'm sure that rings a bell for some traders, because they made home loans accessible to borrowers who should not have received them in the first place. Basically, here's another cool feature of bubbles. When you run out of participants, good, let's say credit-worthy participants, those AAA participants in terms of ratings, credit ratings, and scores, then some institutions, some companies may start turning to, less trustworthy, well, not trustworthy, but less financially safer potential corners of the market. And that was the key problem of the US housing market crash. And that led to a lot of laws and rules placed since then to help prevent that from happening again. So a lot of these borrowers received loans who shouldn't have, basically, in the first place. And these are called subprime loans. And then financial firms would sell those subprime mortgage loans to more larger commercial investors in what's called as mortgage-backed securities. And then, the prevailing sentiment was that, housing prices can only go up. But that, of course, is not a given or the case, and it wasn't the case. And then the defaults started happening. And it got to the point where for people who took out mortgages, they were starting to make payments that were worth way more than what their house is worth, which could be a concern these days because, as we know, housing markets, not just in the US, but around the world, have been hot. Can you imagine a situation when housing markets, for example, the US, fall a decent percent, and all of a sudden you're left with a whole bunch of people paying mortgages that are worth a little bit too much than what their housing is worth, right? And people left. They dropped their mortgages. They abandoned their house. There were foreclosures left and right. And that led to a collapse in housing prices. And because of the deep connection of the housing market in the financial system, that reverberated into other parts of the economy, led to the collapse, for example, Lehman Brothers. And what's interesting about this crash is that the bubble in housing actually occurred way before 2008. If you look over here, right, the top in housing, by looking at the S&P 100 home building total return index, started in like 2005, 2004. So this is actually an early warning sign, which I guess not many economists were able to catch, unfortunately. But yeah, so that developed into the financial crisis, and a similar theme here was that there was a liquidity issue. Credit literally froze up because no bank wanted to lend to each other. No bank wanted to lend to any person. And that's where, for example, institutions like the government and the central bank had to step in to restore confidence in the financial system. And it is arguably those policies that were developed in the aftermath of 2008 that helped to support the economy after COVID, which actually would be a great actually segue at this point into the last component of this presentation, which I wanted to spend the most time on, is looking at if we are currently in a bubble, or are we currently topping? Is this euphoria? Are we disconnected from reality? So let's look at some charts here that I have pulled up for you. So this is a chart that compares the US indices percentage change basically since 2020. So this captures where prices started here at the beginning of 2020, including the COVID crash, and what has since followed. So you can see here the turn lower here in equities was actually very, very brief. It only lasted about a month, but nevertheless, this collapse in equities was the fastest, I believe, we had entered what's called a bear market, which is when you fall in excess of 20%. That was the fastest pace that the US stock market entered a bear market on record. But at the same time, it was arguably also one of the fastest recoveries from a collapse in stocks also on record. And the reason why I think that came to be the case is what I was just talking about with that example of the 2008 financial crisis. All of those policies that were developed by economists, most famously Ben Bernanke, from the former Fed chair, governor during that crisis, quantitative easing and bringing monetary policy to zero. Prior to the outbreak of COVID, the U.S. economy is actually was pushing higher. The Fed had to raise rates something like 4 times in 2018, but then had to reverse course in 2019 because of troubles in global growth. It was already in the process of unwinding its stimulus measures and all the assets that have bought up in the aftermath of 2008. But when COVID occurred, the central bank dropped rates back to zero, restarted what's called quantitative easing, which is something I'll talk about in a future slide. Initially, quantitative easing was open-ended, so the central bank basically was buying assets open-endedly, and that eventually evolved to 120 billion per week, which is, by the way, still going to this day. It wasn't just fiscal stimulus, or excuse me, it wasn't just monetary policy that was aiding the recovery. It was also fiscal stimulus. From the government side of things, right, we got the CARES Act. We got money to fund research into a vaccine. Evictions were banned, and I believe there's current policy in place to extend that ban temporarily for a little bit further. Personal checks were handed out in 3 rounds, and there were extra unemployment benefits at something like an extra 600 per week. Trillions more, by the way, spent on infrastructure. So the difference between what happened after 2008, what happened after COVID, was that we already had the lessons of the 2008 financial crisis in terms of, okay, what monetary policy, what stimulus tends to help the economy, and that was put swiftly into full force very, very quickly. The central bank took no hesitance really to drop rates to zero and restart QE. And so this collapse here in share price was very, very short-lived because all these policies were put into prescription to jumpstart economic growth. And you get this revival in not just stock markets, but economic activity. The US unemployment rate at the peak of COVID was something like almost 15% in April 2020. It now sits at 5.4% only just a little over a year later. I mean, that kind of recovery is I think almost unheard of. And it all comes down, I think, to those policies that were put into place. And I'll talk a little more about those in a future slide. But let's talk a little bit more about these indices. And you can clearly see that there is one that is outperforming the others. That is the Nasdaq Composite. But let's start actually by looking at the one that has been performing the worst, which is the Dow Jones. And when I say the worst, I mean relatively speaking, because the Dow Jones at this point has reclaimed its peak prior to the COVID crash. Same thing with the S&P 500, same thing with the Nasdaq, right? So we're just comparing relatively speaking, right? So the Dow Jones is essentially it's the oldest of the three. These are only about 30 stocks in the Dow Jones, very exclusive, and the weight is determined and ranked by share price, and is mostly in blue chip companies. So healthcare, United Health, Home Depot is a famous one, Salesforce, McDonald's, Boeing is another famous one, Caterpillar. Dow Jones is actually a very tied to cyclically sensitive sector, which we'll talk a little bit more in the next slide. The S&P 500, in the meantime, you can think of it as in between something like the Dow and the Nasdaq. The S&P 500 includes 500 companies that are market capitalization weighted. It's the best gauge of large cap US equities. It is the most representative, essentially. So it's very diverse, but it also includes tech companies too, like Microsoft, Apple, Amazon, and Alphabet. And really the one that's just been taking the cake here is the Nasdaq Composite. It is highly concentrated in the tech stocks. So it's very, very, that also makes it the most highly sensitive too, because it's so tied to a particular segment of the economy. And the largest of those in the Nasdaq include Apple, Amazon, Microsoft, and Facebook as well. So you can clearly see here where investors were chasing money after the lows of the crash, and where they thought that the segment of the economy would perform the best, and that is in tech. That's something that I'll be able to better describe actually in the next slide. So now we're going to actually take a look at sectoral breakdowns here in the aftermath of basically 2020 and including that crash. So what we're looking here are what's called ETFs. ETFs are just a collection of securities, basically a basket. And what these ETFs they are from Vanguard, and they track the sectors of the economy. So these include energy sector, financials, industrials, healthcare, information technology, consumer discretionary. There are more, obviously, and it is these sectors that make up the broader indices that I pointed out here in the last slide. But you can clearly see which sector of the economy has been doing the worst: energy and oil stocks, which makes sense because, as I mentioned earlier, those are the cyclically oriented ones. Now, we'll talk a little more about cyclical shares. Cyclical shares are ones that move in flow with the general economy. The economy is not the stock market. So it makes sense that the energy stocks are taking the longest to recover, because it's going to take a lot longer for people to resume traveling, resume flying, resuming manufacturing, resuming all that stuff to power the global economy. So it makes sense that energy stocks would underperform and recover a lot slower than something like information technology, which we can see where the money has been going into, right? Because of the COVID situation and because of lockdowns, an environment where people are able to work from home, well, that just happens to include tech companies, right? People being able to work from home, log in from home, work from a laptop, that's not the same as, going to a refinery or something and, being able to withdraw that oil. And so hence you get this disproportionate recovery in the stock market or segments of the stock market, right? Consumer discretionary, that includes things like Amazon. Information technology are clearly leading. Healthcare is not too far behind, which isn't too surprising. You can see actually an initial recovery here of COVID, healthcare stocks actually were the best performing. And then in the middle, you have your financials, industrials. So that's a breakdown sort of here, what's going on here in terms of the sectors. But there is, even within tech, there is another segment that's doing even better. So now I'm comparing tech versus tech. You can see here, here's the Nasdaq Composite compared to FANG. The FANG are the 5 most prominent American technology companies, which include Facebook, Amazon, Alphabet, formerly known as Google, Netflix, and these companies were really just the one to take the cake within the tech sector itself. Netflix, right? Subscriptions surging because everyone was staying at home. Everybody's more on Facebook because they're staying at home. Everybody's using Google more because they're staying at home. So there's a segment within tech itself that is really just outperforming the most. And if you're looking for, again, when you're looking for bubbles, you're looking for that exponential growth. You're looking for the ones that have been tending to outperform the broader market within an already pretty strong market, and seeing if it's exponential and seeing if these expectations make sense, right? One could argue that it makes sense that tech stocks are so much higher because, well, the economy has been shifting more to them since COVID, because the recovery and reopening is a lot slower. Hence the underperformance in things like energy, financials, and industrials, and the rise in information and consumer discretionary. So the money is going to tech and still going into tech. And I think now would be a great time to look at the sector weights of stock market to sort of take a better look at what that can entail. This is the breakdown of the sector weight, for example, in the S&P 500. And if you look over here, information technology is very near very near 30% of the S&P 500. And I suspect that this ratio is going to continue rising because of the prominence of tech lately. Right? It would be one thing to say that a lot of money is going into, for example, a segment like information technology, but it's a very, very tiny sector of the economy. That could be a sign that, you know, the markets are really trying to price in where it could become in the future and whatnot. But tech is already a prominent sector of the S&P, and it could continue here to grow. And that actually brings me to my next point is, you know, okay, if we're going to start taking a look at, you know, if tech is really overvalued here, then we have to take a look at how much really of it is important to the overall economy. Because if too much money is going into the tech sector and it's not equally representative of the economy as a whole, then you might have a problem. There's too much speculation, and that speculation may be right, but it also could be truly horribly wrong, as it has been before in the past, with, for example, the dot-com bust. This is data, and the charts are from cyberstates.org, but the data itself is pulled from the U.S. Bureau of Labor and Statistics in terms of and whatnot. And we can see here that the economic impact of the tech industry as a whole is only something like 10.5%. Only 8% of the overall workforce is currently tech. So, you know, that seems pretty small relative to what currently seems to be playing out in financial markets. So that, I think, to me, is a sign that there's a lot of hype and expectations being driven to the tech sector become the dominant be-all that's just been amplified because of COVID. Now, tech sector may eventually become the more dominant and end-all be-all, but it's all about the pace. If markets are not pricing in the pace of which correctly, then we could have a problem here, right? So now I want to talk a little bit more about what has been driving a lot of this price action here in markets, and that is taking a look at here the red line S&P versus the Fed balance sheet and the velocity of money. So the Fed balance sheet is this blue line over here. It's essentially the assets that the Federal Reserve has been picking up really since the outbreak of COVID, right? So the central bank is purchasing those long-term securities, mostly treasuries in the open market. And by doing that, it is flooding the system, flooding the banks with excess cash that could hopefully be used to loan out for other business opportunities elsewhere. Essentially bringing down interest rates, making cash really, really cheap. And when interest rates fall, the cash is very cheap and things are very liquid, well, guess what? Stocks start looking relatively more attractive. Because think about it, right? If you park your cash at a bank right now, at a savings account, even a high yield savings account, you're getting almost nothing. Meanwhile, you have the problem of inflation. So where are people more likely to park their excess cash? Stock market is one, real estate is another, which is another hot topic. But note, by the way, here, there's a green line here. This is called the velocity of the M2 money supply. Now, the M2 money supply basically includes how much money and cash there's in the system. It includes actual physical cash and what's called near money, like savings deposits. Typically, what you want to see in a healthy economy, right, is as the economy grows and improves, you want to see that M2 velocity increase, because when velocity increases, that means more money is exchanging hands. But more money has not been necessarily exchanging hands, and this actually could be a risk here, because if velocity starts to pick up here and more money starts to exchange hands, that can lead to higher inflation. And if that leads to higher inflation, we could get more tighter Fed policy sooner. Which brings me to my next point, is looking at what's been helping to drive this push higher in US stock markets since the 1990s. That's just the collapse in Treasury yields, which was amplified by COVID. What's a key competitor to a stock investment? A bond. A bond is what's called a relatively safe investment, especially US Treasuries. When you buy that bond, you're going to be expected to receive that yield, whatever it is, in the future. With a stock, that yield is uncertain. You can get a dividend from the stock, sure, but the actual price of the stock, you don't know where that's going. With the bond, you know where the rate's going to be. So a main competitor to stocks is bonds. And because of 2008 and because of COVID, yields have just been eviscerated, which makes it a really, really, really easy condition for stocks to outperform. Because bonds aren't necessarily attractive, because you're not going to be much for bonds. And, you know, if people have inflation to beat, I'm sorry, but Treasury yield is not going to do it at the moment. But stocks could. Which brings me to my next point, because you can see down here below, this is the core PC, that's the Fed's preferred measure of inflation. We're starting to see a pop in that, the most since the 1990s. Now, central banks have been making a point that the pops in inflation could be transitory or temporary. And they're not quite so hesitant to take action quite yet, but that could easily change if the narrative on that changes. Remember, because of COVID, we've essentially hit basically net zero for monetary policy across the globe. So there is a ton of room here for central banks to raise rates and result in a push higher in Treasury yields. And that is something that I think a lot of investors may not necessarily be prepared for. Because if you get those rising yields, those are going to be the relatively more attractive investment. It's going to make it a lot harder for stocks to continue outperforming. And we'll see where that has to go. But I think that is a very, very clear risk here and could result in a situation where all of a sudden, a lot of overhyped equities could result in decent collapses because of the reversal in QE and the push higher in bond yields. We kind of saw a little bit of this panic earlier this year. And a sign, I think, that the markets are actually quite ready for monetary tightening, actually, is looking at what's going on in the Fed's overnight open market operations. This blue line here is the U.S. financial conditions index. Basically, when this blue line is falling, that means credit is becoming cheaper and looser. And it's very, very, very loose right now. Meanwhile, volumes at the Fed's reverse repo operations are surging to record levels. Now, to understand what a reverse repo is, you first have to understand what a repo is. But long story short, it's part of what the central bank does to help conduct policy to make sure rates are where they need to be. Think of repos as very, 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 very short-term QE, talking about like from days to a couple of weeks. When you have an increase in regular repos, that means that the Fed's trying to increase liquidity in the system. When you get a surge in reverse repos, it's the opposite of that. The Fed is draining liquidity from the system. The Fed has been very aggressively draining liquidity from the system in reverse repo operations. And that tells me that the markets may be ready for eventual monetary tightening. And so as I wrap up this presentation, because we are kind of running here a little bit over time, I wanted to compare how the Nasdaq composite, the tech-heavy Nasdaq composite, surged from the aftermath of the 1987 flash crash to the dot-com bust, relative to the S&P, relative to the Dow Jones. You can see that at just the peak before it topped in dot-com, the Nasdaq was at 1,500% of where it was in the late 80s, versus the S&P and the Dow Jones. They were at about 450% to almost 500% up. But the Nasdaq was 3 times as much higher in the aftermath of that 1987 flash crash. Now let's compare it to what the Nasdaq is close to today in the aftermath of not the 2008 crash, not the COVID crash, but the 2008 crash. So the Dow Jones and S&P are actually running very similar to where the performance was leading into the dot-com bust, right? The S&P is at 490, the S&P here was at 490, the Dow here is at 392, the S&P is at 452, or excuse me, the Dow is a little bit under here. But the Nasdaq is actually at only 960% or close to 1,000%. So even though there's been a similar amount of time and the skews are going up, the dot-com bust was that much more skewed into tech actually than it is today relative to where we are from 2008. And you know, some people could view that as a sign that there's still more room in this rally to come. So as I wrap up this presentation, here's a chart, by the way, of the pop of the major market bubbles over the courses of history and how long they took to occur and how quick they were. I want to essentially try to answer the question is, are we in a bubble, by giving you, as it's really hard to be able to tell you with a straight answer, yes or no, are we in a bubble? So what I'm going to leave you with instead are 3 reasons why I think we're in a bubble and 3 reasons why I think we're not in a bubble to wrap up this conclusion. Then I will leave this back to Todd to wrap this up. So 3 reasons why I think we are in a bubble. 1, I think it's currently we're just very heavily concentrated in a specific section, that is tech, meaning that expectations could be way too high, similar to those expectations we've seen throughout history in the Tulip Mania, the Great Depression, dot-com bust, 2008. Very heavily concentrated right now in one sector. And that I think is one reason. The other one is that some investors may not be ready for a rising yield environment. We've had a decade of low interest policy. We haven't had a period really of just tight policy because inflation has been too low, and that could start changing because of what the impacts of COVID have been on the global economy. And as I mentioned earlier, when those yields, bond yields start to rise, stocks become less attractive. Stocks become less attractive, you will start to see the immediate withdrawals in the most overhyped segments of the market first. Things that come into mind, for example, Tesla could be one, GameStop, AMC, a lot of those meme stocks potentially too. Another risk I think is that, again, what I mentioned earlier in terms of the inflation here story, resulting in stagflation. If we get higher periods of inflation but low growth, that's not necessarily good for the economy. We're starting to see COVID cases rise in parts of the world, but inflation is still remaining persistently high. So central banks could be left with a difficult choice here. And the central bank's choice in the 80s was to ultimately tame inflation. And it could happen again. All right, and now 3 reasons why I don't think we're in the bubble. The first is that even though we could be heading towards eventually tight monetary policy, the point is today, right now, monetary policy is still pretty loose. We still have absorbent amounts of QE, and we still have decent amounts of fiscal stimulus. Again, it's really, really tough to pick those tops and bottoms and bubbles, but the fact of the matter is, currently today, policy still remains loose. So we will have to revisit this question closer towards the end of 2022, possibly in the mid of 2023. The second reason for that, why we not necessarily be in bubble, is that there's still pent-up demand to yet come. As people start to travel and go out again, demand for traveling could be what's called inelastic, which means people might be willing to pay more for the same good to travel as they did before COVID. It's kind of like how we're seeing this, rise in housing prices. Some people are still willing to pay those higher price for the same good because it's in such high demand. So we might get the same for that in terms of travel and tourism, and that could keep the economy growing, which could keep equities perhaps afloat. And the third reason why I don't think we may not necessarily be in bubble is what I mentioned earlier. I'll scroll back to this very, very quickly here, is that this surge in reverse repos. The Fed is already trying to take liquidity out of the system, and it tells me that the markets are ready for that. So again, and that's just going to have to be a question that is answered with time. And so those are the 3 reasons why I think we are in a bubble and why we may not quite be in a bubble. Again, trying to predict whether or not we're in a bubble is a very difficult question itself. So that's why I wanted to leave you with sort of those thoughts. I know I'm running here a little bit over time, Tom, but I see I have a question here about if I think about real estate sector. So I'll answer that just really, really quickly here, because I've seen a lot of stories about this, and it's certainly a topic that I'm interested in. But I think a key problem with the housing market right now is that there's a very, very deep lack of supply. And you combine that deep lack of supply with essentially something like your loose monetary policy and this surge in demand for people to live in more of the suburbs and whatnot. And because of all the policies in the aftermath of 2008 to prevent a lot of the subprime lending, right? What you're getting is a lot of people who are flush with cash buying up property because there's just so few of it. So yes, the real estate sector is booming, but I think it's booming for the right reasons, and that is in itself could be a problem because of course you get that huge lack of supply. And I think the biggest threat to that housing market is well, from a purely price perspective, right? Because it's debatable whether or not a drop in the real estate sector is good or bad. But the way I see it as the biggest threat to the real estate sector is just a huge increased supply. Let's say a politician starts to enact policy to tackle a housing shortage, to boost supply, build more dense apartments in cities near transportation hubs. And that's, I think, a good problem to have, but I think it does tell you that the market could be running a little bit too hot here. And I hope that helps to address sort of your question in terms of what I think of that. And that's actually going to wrap it up here for me. I hope you guys enjoyed this discussion, and thank you, Todd, for having me on board. I'm always happy to have these discussions. These are very interesting topics to me. I hope to be able to participate this again So, Tom, if you want to wrap it up things from here, I'll be more than
Yeah.
happy to give it back to you.